then Wednesday, we're going to start chapter 5, and we have 3 days on chapter 5, and then we have a quiz. And then after that's the test. So this next test is over chapters 4 and 5. So today we're going to go over just problems. That's all we're going to do today is just work problems. And the one that we're starting with is exercise 2, and it's on page 192. Exercise 2 on page 192. Now, the weird thing is about these kind of problems is it's not that you're just going to take a bunch of numbers and throw them on the income statement, because you have to make a decision as to where they go, and do they need to adjust like prior year numbers, or do they need to go on retained earnings? You have to kind of know what sort of treatment these unusual items get. Like we talked about, there are those 4 types of unusual items that were on the one table and the 3 types that were on the other table. So all of those, now you need to know what to do with them on the income statement. Okay, so what we're going to be doing is doing a lot of income statements today. And the first one is exercise 4.2. So how does the income statement start out? The multi-step income statement. Or where's your example of how an income statement goes in the book? Where's that? $165. Okay, yeah, that is the multi-step income statement. But what about those other unusual items that we, and that'll show you how it starts out, right? And then let's get the one that has the discontinued operations and stuff in there. And that's on page 172, right? That one, actually, there might be a better one on page 178, because it has extraordinary items in there, right? Page 178 has extraordinary items. And yeah, so anyway, how does an income statement start out? Sales. Yeah, revenue, sales less cost of goods sold is equal to gross profit. Okay, so in this case, yeah, that's how we're going to do. We're just going to say sales less cost of goods sold equals gross profit. Okay, so I'm abbreviating all this. Okay, so you see how I'm doing? This is just on 4.2. Now, what they wanted us to do in 4.2 was come up with income from operations, net income attributable to Veal Company. Okay, so those first 2 items, the 310 and the 140, that was easy enough. Now, the next thing on the income statement is what after that section? Selling expenses and or administrative expenses. A lot of times they separate these, but here they've combined them together. Selling and administrative expenses are 50. What comes after that on the income statement? What comes after selling and administrative expenses? Other gains and losses. Okay, so do we have any other gains and losses? What's that? Oh. So now we're coming to the hard part, right? What we have to know is how to treat the next items: gain on sale of plant assets, unrealized gain on available for sale investments, interest expense, loss on discontinued operations, right? Those things. Y'all have any ideas on any of those?
So we can put other gains first, and then gain on sale of assets.
So gain on sale of plant assets is an other gain, right? Okay. So gain on sale of plant assets is an other gain. What about any of the rest of them? Now, one thing that that we want to get to is, where does our income from operations go? Okay, skip it. Oh, the 120? Okay. So what about interest expense? Where does it go? Okay. Let's do interest expense right there. All right. Gains are 30. Interest expense is 6. What about unrealized gain on available for sale investments?
It's unrealized, but it could be realizable.
Okay. No, not really. It's either realized or it's not realized in this sense. Okay, if it was a gain on the sale of investments, where would it go? If it was a realized gain on the sale of investments, where would it go? In other gains and losses, okay? But it's unrealized. So what is that? These are tough, right? An unrealized gain is other comprehensive income. Okay, that's other comprehensive income. Usually, a lot of these unrealized things go in other comprehensive income. And if you look in other comprehensive income in your index, it'll give you a page number that's more like towards the back of the book that gives you a list of about 8 items that are other comprehensive income. And this is one of those. Unrealized gains on a lot of things, or unrealized losses. Those usually go into other comprehensive income. Okay, so we're going to skip that for now, because what do we do with other comprehensive income? We have 2 choices. It can either be adjust retained earnings, or we can include it on the income statement at the very bottom. Okay, so we're skipping that unrealized gain. So what all have we handled so far? Everything down to loss on discontinued operations, right? Where does that go? Down at the bottom after our regular net income, but before extraordinary items, right? Which we don't have. Do we have any extraordinary items on this? No. We don't have any extraordinary items. So we need to get an income from continuing operations here. So this is income from continuing operations. This 144. And then we're going to go our loss on discontinued operations. Now remember, this discontinued operations, we divide that into two parts, right? Our loss from operations of this year and our loss on disposal. And they've only given us loss on discontinued operations, this one number, okay? So, but ordinarily, we would have two numbers here, right? Now, what do we do with this allocation of non-controlling interest? Towards the end, at the very bottom, okay? So, so we have our income from continuing operations, then our loss on discontinued operations, and then what we get there is our net income. And now we're going to take out our allocation of the minority interest, non-controlling interest is what they call it, non-controlling interest, which is 40. Do you see why we're doing this? Why are we taking away the 40 here? Because those are some other folks own part of this company. We have a subsidiary that we've combined into our company, but there's a small part of it that some other people own. So we're taking this out so it's not reflected in our income. It was reflected up here in our income, and now we're taking it out down here. Okay, so this is net income allocated to us. Okay, now that was a lot of confusion, I would say. Were y'all confused? Maybe not? Okay, let's just, yeah.
Well, real quick, the way we just set that up for the homework, where we had the depreciation understatement, does that go under? That goes.
So the homework's due Wednesday.
Yeah.
So you're asking me, where does depreciation understatement go?
Talk about it.
Is that, well, I mean, you're asking me where depreciation understatement goes, right?
I set mine in, so.
Oh, you did? Well, what about, I mean, you can change it. You can always change it, I think. You can change it. All right, maybe we'll come to a problem that had a depreciation understatement. And what is a depreciation understatement anyway? What do we do with that? That's one of the big things on the homework, right? How many people have started the homework? Yeah, okay. Or finished the homework in this case, right? Okay. So yeah, there is a thing on there about depreciation understatement. Would y'all like to know the answer to that part? Yeah, why not? Yeah. Okay, so today, that's the idea. Today we might be going over some things that are going to be useful in the homework. But let's just look at the chart on page 177. Okay, on there we have 4 types of situations. So in this chapter we're talking about the income statement and unusual items. Which situations did we just go over right here? Unusual gains or losses, discontinued operations, extraordinary items, or non-controlling interest. We did discontinued operations, and so the important thing is, where does discontinued operations go? Like we said, it's after continuing operations, which used to be our net income number. This used to be our net income number before this chapter started, right? But now we've added some things below it, okay? So discontinued operations go down there, and what's unusual about discontinued operations, it's supposed to be shown net of tax. So our tax would go up here, but discontinued operations down here would be shown net of tax, okay? So our tax would be allocated between here and here, okay? Now, let's see, what else did we go over in this problem? The non-controlling interest, right? And where does it go? Almost at the very bottom, right here. It's the last thing subtracted out, okay? And then what else did we do in this problem? Unusual, well, yeah, other gains and losses section. Unusual or infrequent things that go in the other gains and losses section, which they, specifically give you a list of write-down of receivables or inventory and stuff like that. And this one was writing down, well, no, it was a gain on the sale of plant assets, which is also in that list. See it? Okay. So the one thing that we haven't gone over in this problem is extraordinary items, where would extraordinary items go? Yeah, right here. So extraordinary items, if we had any, would go right here after discontinued operations. Okay, so we've kind of covered 4 things in this section, and then there's another list on page 181. We've covered none of these. Changes in accounting principle, changes in estimates, correction of errors. Right? This problem didn't have any of that stuff. But that's okay, there was enough in here. So there were a couple of other questions here. What they wanted us to do here was compute income from operations, net income attributable to this company, comprehensive income. We didn't do anything with that other comprehensive income, did we? Other comprehensive income, we didn't do anything on unrealized gain for available for sale securities, right? Do you see what I'm talking about? That $10,000? So remember I said we have 2 choices of what to do about this. And one is that on the income statement, on the face of the income statement, we can have our regular net income and then add other comprehensive income to get a thing called comprehensive income. Okay, so this is the way that we're going to do it. We're going to take our net income. We're going to add something called other comprehensive income. And we're going to get comprehensive income. Now, this all sounds like it's too bad they couldn't think of another way to word this to me, because comprehensive income right here is made up of net income and other comprehensive income. Do you see what I'm saying? It's kind of weird. Comprehensive income is made up of these 2 things, and one of them has a weird name called other comprehensive income. So, in other words, comprehensive income is meant to be a place that includes net income, like our traditional net income, and it also includes some odd things that really the accounting profession has just now started including on the income statement. And those are the unrealized things. What do we mean by unrealized? We haven't realized it yet. We have not realized it. How would we realize it? How do you realize something? Under what circumstances would something become realized? Once you sell it. Once you sell it, then it is either realized or realizable. Okay, so that's what you were talking about, Jonathan, realized or realizable. When you sell something, it is either realized in that you get cash, or it's realizable in that somebody owes you money. Okay, so realized, you have cash. Realizable, it's an accounts receivable. And if it's unrealized, what is it? Usually other comprehensive income, right? So realized, you get the cash. Somebody paid for it. Realizable is somebody owes you money, and unrealized means you haven't sold it yet, and most of the time it goes in other comprehensive income. Okay? So this thing in the problem is unrealized gain unavailable for sale investments. That goes in other comprehensive income. So we take our net income, okay, our net income was this number, 132. This number, because this is our total net income before subtracting out the other guys. Okay, so we take that number, 132, and add our other comprehensive income to get our comprehensive income. Now, the other thing they wanted was a retained earnings statement. Okay, a statement of retained earnings. So what's the formula for the statement of retained earnings? Beginning balance, right? Plus net income minus dividends equals the ending balance, right? That's our ordinary, that's our plain vanilla retained earnings statement. Okay, so our beginning balance in this particular problem, it's their first year of operations. So our beginning balance is 0, right? And we add net income, which again is this 132 number. Let's just label that net income. Okay, minus dividends of 5 gives us an ending balance of 127. Okay, all right, so that is exercise 4.2. The next one we're going to do is exercise 6.
I got a question.
Okay.
So on the unrealized income, say you put it up for sale for December, and you counted, say, $1,000 as unrealized income. When January comes around for the next year, when you actually sell it, do you put that as revenue for next year because you already used it for revenue the year previous?
That's interesting. It was in other comprehensive income, though. You're saying you've put in other comprehensive income a gain. Okay, tell me the scenario again. You put some in as a gain, and then when you sell it, there's a difference. Is that what you're saying?
Say you sell it for the same amount that you have it as an unrealized gain.
Oh, okay. If you sell it for the same amount, then,
You sell
yeah.
it in a different time period.
Right, you sell it in a different time period.
You would have counted the income twice.
In your comprehensive income. but it has not hit your regular income. But it has hit retained earnings. That is an interesting question. Yeah. Let me look into that. That's a very interesting question. The reason that we have this it kind of brings up the reason that we have this other comprehensive income is it used to be the income statement did not include any unrealized gains and losses, and so it was just realized income. But people said, well, that's not really reflective of how basically a lot of people had a lot of unrealized gains that they would like to recognize, that they'd like to put on the income statement. The income statement's traditionally been at historical cost and you don't write anything up. But in the last 15, or in the 90s for sure, and then in the and there've been a lot of gains that people wanted to put on the income statement. But this is like a halfway way to put it on the income statement. In this other comprehensive income, it allowed companies to kind of almost recognize the income because they were getting to put it in retained earnings, but it wasn't on the main body of their income statement. So it was kind of a compromise position to allow them to recognize this income. But now I have not thought about where it goes if you sell something after it's already been recognized there. I hadn't really thought about that. So, good. I'll think about it. All right. So now we go on to 6, right? Okay. So exercise 6. This is a multi-step statement, and I guess it has an extraordinary item because that's what they're saying, right? So, prepare a multi-step income statement. So this is kind of a long problem. For a while I thought, okay, I'm going to get y'all to come up to the board and do part of this problem, part of some of these problems, like we did last time. But why don't we do it this way? Why don't we have you guys come up with gross profit at your seats there? Come up with gross profit. So how do we calculate gross profit again?
Operating revenues minus
Okay.
cost of goods sold.
Cost of goods sold, yeah. Gross profit's normally sales less cost of goods sold, but there's a little bit of extra in this one. Let's say net sales minus cost of goods sold is gross profit. Y'all can talk to each other if you want to. Doesn't matter to me. So, that's why we went and looked back at these sample income statements, so you might, they might be helpful to go back and see how they calculated it. So does anybody have a number? We're almost there, right? Yes.
You took
Oh, so what does it start with? What number does it start with? Okay, that's good. That's a good starting point. Yeah. Okay, so do you want to put that part on the board? Yes. Yeah, just in between here and there. Why don't you start kind of over there? That's good. Okay, so the next section we're going to do, what's the next section? After gross profit. You have this one. Okay, all right, so you're going to come up with those numbers. Okay, so what comes after selling and administrative expense? Jillian, do you know? You're a little behind. Brett, do you know? What comes after selling and administrative expense? Well, I mean, what big section? The next section. You got it? Okay, that's your section. Yeah. Are y'all getting the hang of it now? That's why Jillian's behind. She doesn't want to get the hang of it. Okay, so that's going to be the section you want to do, right, Kyle?
Mm-hmm. Yeah, I'll do it. When?
After these guys, yeah. Okay, so all right, how's gross profit? Let's just look at gross profit. How did that go? Did y'all see how that went? The weird thing was, did y'all realize what to do about this sales discounts and sales returns and allowances? Yeah, this is how you come up with net sales. That's why I just wanted your first number, because then I could tell whether you got that part right. Okay, here we go. So we're doing here, which section are we doing? Selling and administrative expenses. $333? No, you don't need to do that. 4 minus 1 is 3, 6. Yeah, you got it. Or it's not 333, but you got that. Almost. 273. Okay. So y'all got the selling administrative expenses, right? That's not too bad.
number? Not
Oh, yeah, bring everything, whatever. Excellent. You added that that's income from operations, right?
I just
Yeah.
So I wouldn't get mixed up.
Yeah. Perfect. All right, here's a sticky note to hold your place. So we don't have anybody for the next step. What comes after other revenues and losses? Other gains and losses. Other gains and losses. What comes after that? Right. There's an intermediate step right before that. Yes, that's your deal. And you can go ahead and do discontinued too, right? Since you got 2 for 1. Didn't he get 2 for 1? Am I wrong? The income tax is easy, right? What do you do with income tax? I mean, that's an easy part.
Would that be it? There's
Okay, you have interest revenue. Do you have any other expenses?
revenues in here.
Yeah, that's it on that.
Yeah, that's it, right?
Mm-hmm. That's $359. Then do we have any other expenses and losses?
Oh, you want me to do that too?
Yeah.
Okay.
Oh, sit in the chair. Look, there's your chair.
Yeah, bad one.
Okay.
I could have kept them. I could have done revenues and losses or gains and losses in the same.
You could have, yeah, but that's fine.
Okay.
It's best to separate them because you want all the things that you add normally in one section and all the things that you subtract in another one. So that's fine that you separated them. So have you found the discontinued operations yet? Oops. Did you find discontinued operations yet?
I don't think there is.
Oh, yeah. Golly, that's a bummer. All right, so it looks like you're just down for taxes, right? Okay, thanks, Kyle. So now we're doing taxes. That number is income before taxes. $299. What's our income tax number?
It's 34%, which is 101 points, or 66,000. Or, I'm sorry.
660. Yeah. Okay, which gives me 197,340. Okay, so what do we call this number? That 197,340.
Income from continuing operations after.
Yeah, or something like that. What's our next thing that we have to do? Jonathan said we don't have any discontinued operations, right? So what comes after discontinued operations? Nobody wants to say. Extraordinary items, right, extraordinary items. Okay, so this is now income before extraordinary items. And then our extraordinary item is what? Do we have an extraordinary item? Right, loss from earthquake damage. All right, so now how do we show extraordinary items? Do you remember where extraordinary items are? They're on that chart, right? Yeah. And then they're also, you've got them in the book there. So what are we supposed to do to extraordinary items? What's the weird thing about them? Other than they come after discontinued operations, there's one more important thing. You take out the income tax. Okay, so our loss from earthquake is 150,000, right? And what is the tax on that, Jonathan? $51,000. Okay, so how do we do that? We took, we did 30% taxes up here. Now we're doing 30% taxes down here. And remember, this is a loss. So this is actually a tax benefit, right, that's going to reduce our loss. So that's $99,000. So our total tax is this number.
Where did we get that again?
Now this is 34%?
No, where did we get the income tax from? I didn't.
Oh, it gives you what your tax rate is.
Oh, okay, I got it.
34%. Yeah. Okay. All right, so now we've handled the extraordinary item, right? Yeah. So our net income is $98,340. Is there anything here we have not done anything with? We've handled all this, right? Yeah. But they wanted us to do a multi-step income statement. So we're done, right? Earnings per share. I'm glad you mentioned that. Okay. So per share. Now, when we do earnings per share, we need to do earnings per what kind of share? Common stock. Okay, so when we do earnings per share, what things do we need to do earnings per share for? What items? Avery, were you looking there at earnings per share?
It's the net income margin for dividends.
Yeah, okay, that's the formula. That's the formula. So we do it for net income. Okay, good. We do it for net income. This number, net income. Let's label that net income. Here's our earnings per share down here. No need to draw a line. I'm just kind of off whack. Okay. So we're going to do earnings per share for net income, right? What else?
You do it from each one of the incomes that you find.
Okay. So in this case being, okay, where are we looking here to find this out? 177. Yeah. So there we do it, income from continuing operations, income from discontinued operations, income from extraordinary items, and net income. So we have an extraordinary item, so we need to do it for this number, and we need to do it for this number. Okay? That's what we're doing earnings per share for. Okay, so in this case, we're going to do income before extraordinary item, and net income. Okay? Sometimes they break out the different parts of this extraordinary item, but we're just going to do it for the total right here. Okay? So income from extraordinary item is 197 divided by 100,000 shares. This is our formula, okay? This 99,000 divided by 100,000 shares. 500,000? Common stock is 500,000?
But it says at the bottom, 100,000 shares of common stock were outstanding.
Oh, that's the dollar amount. That's the 500,000 is the dollar amount. Okay, yeah, but 100,000 were outstanding. Okay, and then this one is net income divided by 100,000, right? So that's what we're going to do. So it's $1.97. 99 cents and 98 cents. Okay. Now I don't know what time it is. All right, so we've done 2 exercises today. Let's see how much time we have left. What time is it? What? 10:29. So oh yeah, we have some time. Okay. Exercise 9. Okay. Exercise 9. I think I can just kind of erase some of this stuff and we can do the same thing all over again, right? All right. So now let's compute gross profit. Somebody else gets to do gross profit this time. Whoever gets the number first, let's see what it starts with. It's a race. You've got it? Okay. It starts with 5. It does start with 5. Yeah. Okay. So what do we need to do? Erase this, right?
It gives you the net sales altogether.
Yeah. So it's pretty easy now. We don't have to do that little bit, right? So sales revenue is $1,003,000. Cost of goods sold is $780,000, which leaves you gross profit of $520,000, right? Okay, now we're going to get income from operations, this number. The idea here is that y'all are learning the order of events, right? The format of this statement. Okay? So now we want to know income from operations, and the first person can give me what that one starts with. Oh, well, yeah. It kind of ends with that too. Okay, so selling expenses is 65.
Administrative, 48.
48. And that totals 113. So 407. Okay, right? Now, who's going to tell me other revenues and gains? What items do we have that go in other revenues and gains? Kyle, you got it?
Dividend revenue.
Excellent. Okay, and those are 20,000 and 7,000 for a total of 27. And do we have any other expenses and losses?
Maybe right off of inventory.
Right off of inventory. And remember on the chart there, it lists the things that go in other expenses and losses, and writing off inventory is one of them, right? Okay, so writing off inventory due to obsolescence of 80,000, that gives us 354,000. So this is income before taxes up here of 354. Okay. Income tax? How do we find that? Again, it's 34%, right? So just multiply that, and it's 120,360. Okay, so income before extraordinary item is 233,640. Okay. I'm not going to go all the way through this because this is the same way that that last one went with extraordinary items, and it doesn't have discontinued operations. This number's 233. Net income right here is 200, 640. And these numbers are 389, 55, and 334. Okay? So since we did one that's kind of similar to that, I'm just not going to go over the rest of it. Okay? All right, so that is 4.9. But the big thing in 4.9, then the reason I wanted to do this one is they also wanted you to do a retained earnings statement. Oh, wait, we left something out, didn't we? What have we not done anything about? Depreciation. Does this sound familiar, Kyle? Yeah. This is the thing we're not sure what to do with. Or at least Kyle's not sure what to do with, right? So where are we going to look to find, let's see, what do they tell us about this? Depreciation expense omitted by accident in 2013. Y'all are going to have to help me with this. Where should we look to find this out? What does that sound like? Omitted by accident? What is that? Does that sound like an error? Yeah. It does. Okay. Yeah. An accident is an error. Yeah. So my son today, he lives in Valdosta, and he got up this morning, and he got up at 6 o'clock to be at work at 8. It's an hour and 40 minutes. Well, no, he didn't get up at 6, right before 6. And so he needed to be in Valdosta at 8. So he loaded up his car, got everything out there, and he came back in. He said, oh no, I have the keys to unlock the car, but I don't have the keys to crank the car. And I'm like, this has happened before. You've done this before, and where are these things? And he said, I left them in Anna's car. And I said, you've done that before. He said, I didn't do it on purpose. So what do we call that? An accident, right? This was an error that he had. So anyway, yeah, does that sound like an error? Yeah. All right. What do we do with that, Kyle? What do we do with this sort of error? A prior period adjustment. See, you would have done well on the homework.
I think I did.
You might have done that.
I just wasn't 100% sure.
Oh, gotcha. So what do we do with a prior period adjustment? What does that mean exactly? Does it go on the income statement here? Have we made a mistake and left it out? Are y'all on the table, looking on the table? What does it say to do with prior period adjustments?
Restate prior year's income statements to correct for error.
And,
Show net of tax.
okay, and
what?
we don't have the prior period's income statement, right? So what do we do? Unfortunately, they didn't write the exact words I'd like to see right there. What page is that table? I see it. Okay, look at the one on the top. Recast prior year's income statement on the same basis, show net of tax. Yeah, treat as a prior period adjustment. Okay, to correct for error. Yeah, it doesn't really tell you the whole thing that I want them to tell you right here, which is, where does it go? Well, do they give you any kind of clues? Maybe on the next page.
And I think that's all I did was on the retained earnings.
Okay, so on the next page, what is this? Correction for understatement of net income in prior period, right? That's an error, right? It says inventory error.
So it doesn't go on the income statement whatsoever?
No, because it's on the prior year's income. It should have fixed a prior year income statement. Why can't we put it on this year's income statement? It should have been on a prior year, okay? All right, so yeah, you sound like an expert on this one, Kyle. What we did something kind of like this when we went over this, though. Remember, our statement of retained earnings originally had a balance. Remember, we're going to get rid of this part. So the formula, for retained earnings is retained earnings beginning balance plus net income minus dividends, right? Equals retained earnings ending balance. But if we have a prior period adjustment, what do we do? Look at that table on page 182. This retained earnings on January 1st right. So, yeah. So we have retained earnings as reported. This was what it used to say, which was 980, right? And then here we're going to have whatever our prior period adjustment is. In this case, it was correction of error of net income in prior period, right? And then we're going to have retained earnings as adjusted. Okay, so you see how that goes? We're going to have some number here, and then we're going to have retained earnings as adjusted, and our net income, well, we've erased that number, was $1,144,340. And we had dividends of $45,000. So to get an ending balance of whatever that is, right? Now, the thing that we have to come up with is what is our correction of overstatement there of net income. They tell us depreciation expense omitted by accident in 2013 is $55,000. In this case, we have to adjust it for taxes. Okay, that's the only unusual thing here. So it's $55,000 net of tax, $55,000 minus tax of $18,700 equals $36,300. Now this isn't how you'd write this. I'm just giving you these numbers so you'll have them. Okay, what you would write there is describing the error. Correction for overstatement of net income in prior period. Depreciation error. Okay. So we're reducing net income because for the depreciation, $943,700 and $1,099,340. Well, this was an unfortunate choice of problems here, in that we have this depreciation error, right? Wouldn't you say, Kyle? Unfortunate? Okay. Okay, so now we're done, right? Avery, are we done now?
Where do you get the net income of $1 million? I have $200,000.
We did have 200,000. Yeah, I wrote the wrong number there. 200,640. Let's see if I wrote the rest of the wrong numbers there. Oh yeah, and then this is 1144, 340. Yeah, okay. So now are we done with this problem? We're not done with the problem, that's why I'm saying that. What did we forget to do? Did we do earnings per share? I don't remember doing earnings per share. We did them? Okay, good. All right, so we are done with the problem. Okay, so that is exercise 4.9. Okay, so I had 2 more problems I was going to do. We have 7 minutes. That's not really enough time. So maybe it's no need to do that one. Okay, so problem 3. This is kind of a little different sort of problem. Problem 3 on page 197. I think this is something that we can go through and maybe just talk about. Okay, so page 197, problem 3. We had some additional transactions that were not included in their income. They calculated income of $790,000, and then there were some other transactions that they did not include in that. So the idea is here we have to figure out what each one of these additional transactions should have happened to them. They messed up, okay? So on number 1, they had an uninsured flood loss extraordinary in the amount of $90,000. I guess all I want to know is where should this go? What is this thing? Extraordinary item. It's nice that they told us. And then, so where do extraordinary items go? Right, on the income statement after
your net income.
after
after your income tax.
after income tax, and also after
Other expenses.
after other expenses and losses. They're kind of almost the last item, but there's something that goes right above extraordinary items. What is that? Yeah, it comes before extraordinary items, but discontinued operations. Maybe that's not on that one that y'all are looking at, right? But the way that it goes is, all of your income statement items, then income taxes, then income before discontinued operations, then discontinued operations, then extraordinary items, right? And then at the very end goes the allocation part, right? Okay, so the order is important. So that's where that goes. And what's the other weird thing about extraordinary items? Where it goes is one thing, but we show it net of tax. So we would have to calculate the tax on that number and put it on there. And then also we do earnings per share for extraordinary items, okay? Number 2, in the beginning of 2012, they purchased a machine for $54,000, and the salvage value was $9,000, and it has a useful life of 6 years. And the bookkeeper used straight-line depreciation in all of these years, but they did not deduct the salvage value. So what we're saying here is the formula for depreciation is cost less salvage value divided by the number of years, and this is for straight line. This is the straight line the formula. But, what they did instead is they didn't subtract the salvage value. What do we call that the bookkeeper did, Kyle?
That is a depreciation error.
That's an error, yes. And how do we treat depreciation errors or errors, period? As a prior period adjustment, right? Okay. All right, so now the next one, we had a sale of securities that had a loss of $57,000. Sale of securities had a loss of 57,000. Where should that go? You got this one, Jonathan, right? Sale of securities. You got this one? Yes. Other gains and losses on the income statement. They accidentally left this off, though, right? So we need to put it in there. Okay, so on the next one, let's skip number 4. Number 5, the corporation disposed of a division at a loss of $115,000 before taxes. Where does that go? They sold a division. What is that? What do we call that? Yeah, they actually tell you it meets the criteria for discontinued operations. And the criteria for discontinued operations is what? That it was a segment that they kept track of separately. So apparently this meets that criteria. So where do discontinued operations go? On the income statement after... Yeah, continuing operations and after taxes and stuff, and before extraordinary items. Okay, yeah, y'all are getting the hang of this. Okay, and the next one, they decided to change their method of inventory pricing from average cost to FIFO, and this would affect prior year income. What do we call that? Excellent. Change in accounting principle, and how do we, what do we do with that? What page are you on? 181. Okay, so what do we do with the change in accounting principle? On the right side, on the far right. Yeah.
Recast prior year's income statement on the same basis as the newly.
Right, and what do we call that? A prior period adjustment. So we would do the whole thing with retained earnings for that also. Okay, and I think that concludes all the problems that was a lot of problems, right? Okay. Okay, so I'll see y'all Wednesday.